Truman Cravey was 72 when he hired me to become a financial planner with IDS American Express back in 1987. He was not only my boss, but also my mentor for many years, and he continued to work for me even after his retirement from IDS. He'd been in financial services for 40 years, dating all the way back to World War II when he sold war bonds and certificate of deposits. He taught me a lot in preparation for my 32 years of work as a financial advisor. I remember two sayings that Truman had, pithy sayings that have really been helpful for many years. The first was, "A man convinced against his will is of the same opinion still." And then the second quote that I love of Truman's was, "Never make a bet against the American economy. It is the strongest economic engine in the world and that the world has ever seen." I can't think of two ideas that are more important for us to consider during the coronavirus than these two quotes from my friend Truman. Let me deal with the second quote first. This quote says, "Never bet against the American economy. It is the strongest economic engine in all of history." You know, in times like these, when the market is going crazy, it's hard to believe that. As I said, I began my career in 1987, the year of the biggest one-day market crash in history. Monday, October 19th, 1987, the Dow Jones Industrial Average fell 22.6%, and the S&P futures contracts declined 29% on that one day. Both of these are more than double the one-day percentage drops that we've seen in our current daily volatility. And that's important to note. Back then, the headlines asked the question, does 1987 equal 1929? And it also stated that the world is different now. Similar to 1929, many people lost their lives because they couldn't cope with the possible economic damage that this event would incur. Today's headlines, however, are extreme on both ends of the spectrum. I read an article today titled, "Coronavirus Fears Will Send the S&P Swooning Again to All-Time Lows." But then a second article was titled, "You Can Practically Steal Stocks at the Current Market Prices." So what are we to do when we have such conflicting ideas of what the future holds? In 1987, the drop was steep and fast, and many people thought that this was the end of our financial system as we knew it, the end of prosperity in America. The economic engine had blown a gasket, and it would never be able to be repaired. I'm glad that I had a mentor who had lived through many other financial crises, including World War II, the Korean War, the Asian flu, JFK's assassination, the great hyperinflation years of the 1970s, as well as the oil embargoes. And through his wise counsel, I was able to see the truth in his statement that the U.S. economic engine is the best economic engine that there's ever been. So over the last 32 years, I also have lived through some tumultuous stock market crashes. I've managed money not only through the 1987 crash, but also the Gulf War and the savings and loan crisis in 1991, the dot-com bubble burst, and the 9/11 attack and market crash that followed. Not to mention the 2008 Great Recession and market crash. I've come to believe even more strongly than ever that it's never a good idea to bet against the U.S. economy. The chart you're seeing now confirms just how insignificant the 1987 crash was relative to the past 40 years. I firmly believe that 5 years from now, we'll look back at 2020 as a health crisis that became a financial crisis. But Americans and the American economy not only survived, but also pulled out of it stronger than ever. This leads me back to the first quote. "A man convinced against his will is of the same opinion still. When big market corrections occur, we need to ask ourselves, do we believe that the American economy can pull itself out of the current mess that we'll experience, or will it collapse? The United States has seen more than 200 years of proving that it can overcome every obstacle that it has ever been given. And I don't know why we would think differently this time. As the saying goes, bad news sells papers. In the modern age, bad news drives internet clicks and it attracts viewers to cable media channels. And our technology makes the information instantaneous. The only way that they can keep us tuned in or keep our attention or keep us online is by making short-term predictions, and the more dire the predictions, the more we tune in. I've yet to read any articles during this crisis that take a look at the current situation with a perspective or a time frame of more than 6 to 9 months. So will you allow the short-sighted nature of the daily news to change your opinion of America? Do you really think that this will collapse our economy? For more than 30 years, I've educated our clients that stocks are a long-term investment with a minimum time frame of 5 years or longer. This crisis may not pass in 5 weeks or even 5 months, but I'm confident that in 5 years, the U.S. economy will do what it has always done. It will come back, and when it does, it will come back strong. My job is not to convince you to believe what I believe, because I know that a person convinced of something that they don't believe will always revert back to their original beliefs. So if you've become convinced that this is the end of the American economy as we know it, then please call my office so that we can talk and we'll rebalance your portfolio based on a doomsday scenario. But I firmly believe that fear-driven selling always leads to regret in the long run. Finally then, how does this perspective influence how we're managing your money today? First, as we've always said, we are asset allocators. We are not market timers. We were well positioned going into this market crash. We've told everyone that if the market crashed, we expected that our portfolios would drop by roughly half of the market. I'm very proud of the fact that our portfolios have done exactly that. At its worst, the market was down about 36% last week, and our portfolios were down 17 to 20%. We were already very defensively positioned with high allocations to bonds and hedged equities going into this crisis for the very reason of being prepared. Second, cash and bonds are not stocks. Please don't get confused by the media that all investments are crashing. We have plenty of cash and bonds on hand to support our retirees' income withdrawals without having to sell any stocks at low prices. And third, the yield on our portfolios is between 2.2 and 2.4%. What does that matter? Well, in most cases, if you're retired, we have you withdrawing about 4% per year. Our yield is important because that is the income that comes into your portfolio from investments without having to sell anything. And don't forget that 2.2% is more than you'll receive at a bank. Therefore, to make up the difference, we need to only sell about 2% of investments each year to meet a person's withdrawal needs. If, for example, we have 40 to 50% of your portfolio invested in bonds, and if we sold bonds to supplement your income, we could support your income for the next 15 to 25 years without being forced to sell stocks at the wrong time. That's an amazingly defensive position to be in, and it gives me great confidence that we have plenty of safety in our portfolio to ride out a stock market correction over the next 6, 9, 12, 24 months. Let me draw a couple conclusions. Being glued to the TV or your computer to get the latest updates on the virus is debilitating. It causes fear and anxiety, which will harm your health. Please seek to find positive things to think about and recognize the strength of the American countenance and the economy. One thing I can say is that I have never seen in my life businesses step up to work with the government to solve a crisis the way that we are seeing today. Maybe a few of you are now over age 80, children during World War II, and you can remember the last time that businesses and government worked together. But I'm amazed now to hear of companies like Abbott Labs, who've developed a quick test for the COVID-19 virus that takes minutes rather than days to get results. And that Cigna and other insurers are waiving copays and covering 100% of treatment for the coronavirus. And that companies like GM and Ford and GE and many others are stepping up to manufacture much needed medical equipment. And also that pharmaceutical companies are working with the CDC and the FDA at unprecedented speed to find treatments, drug approvals, and possible vaccines. These are partnerships that have been unheard of in recent times. Just today I read about 16 companies that are working on potential vaccines, including companies like Pfizer, GlaxoSmithKline, Gilead, and many others. I'm confident that we'll find a solution to this. And I also remain confident in the American economic engine, and our portfolios are well positioned to ride through this storm. Economic numbers are going to get ugly in the coming months. Your portfolio will weather the storm. Keep in mind that once the virus has passed, no matter how bad the economic data looks, it will be looking like it's looking in a rear view mirror. It will be reporting conditions that caused pain, but no longer exist. We will not be conducting panic selling to go to cash at times like this. I believe that investors who do that will regret it a couple years from now. I've never seen anyone who sells at market lows that would then have the courage to get back in until long after an economic recovery. So, we are asset allocators, not market timers. This portfolio management strategy has served me and my clients well for the past 32 years. And it served my mentor, Truman, and his clients very well for nearly 50 years before that. I feel comfortable that it will going forward. Thank you for the confidence and trust that you've placed in me and Simmons Capital Group and our team. Don't hesitate to call us if you have questions or concerned. We look forward to talking as you have need, and we will get through this crisis together. Thank you.